Hello everyone, I am Dr.A.G.Mythili, Assistant Professor, Department of Commerce with Finance. In this video, I am going to explain about cost accounting. So, what do you mean by cost accounting? Cost accounting is a process of recording and reporting all the costs incurred by a business by applying cost principles, methods, and techniques. It is also known as cost accountancy, and it is one of the branches of accounting. Cost accounting is the reporting and analysis of a company's cost structure. Cost accounting involves assigning costs to different objects that can include a company's product, service, and any business activities. Cost accounting is helpful because it can identify where the company is spending its money, how much it earns, and where money has been lost. Cost accounting is distinct and separate from general financial accounting. Now, coming to the objectives of cost accounting, it fixes the selling price. It makes a foundation of total cost. We can calculate the total cost. It determines the profitability of the product. It controls cost, and it handles bonus plan in any organization. It helps in proper decision making to the management, and it makes statements to the users, and it enhances communication among departments. Importance of cost accounting. It is helpful to find out the total cost as well as cost per unit of a product. It is profitable and non-profitable activities can be reviewed. It is determining the selling price of the product. It measures the efficiency of different activities. It is useful to prepare estimates and tender. It discloses reasons of loss and wastage. It controls cost reduction. Coming to the types of cost, standard cost accounting. It identifies and analyzes the difference between ideal cost to product a good and actual cost. It is used in manufacturing concern. Activity based cost accounting. It assigns cost to specific products and services produced by activities in an organization, and it is used in a factory environment. So marginal cost accounting, it excludes fixed costs and focuses only on variable cost when booking a product cost. It is a situation where net product is required. Learn accounting. Incorporate efficiency into its cost calculate to provide numeric feedbacks on lean manufacturing and inventory process. It is used in manufacturing process. Now coming to the element of cost. Cost is divided into material, labor, and expenses. So material cost is again classified into direct material, indirect material, and labor cost is also calculated into direct labor and indirect labor. Expenses is also calculated into indirect expenses and indirect expenses. So the indirect material, indirect labor, and indirect expenses altogether are known as overheads. So direct cost. Direct costs are the costs that relate to production of goods or services. So it includes direct raw material, labor and expenses, or distribution costs associated with producing a product. So indirect costs on the other hand are expenses unrelated to the production of goods or services. An indirect cost cannot be easily traced to a production department activity or project. For example, with Ford, the direct costs associated with each vehicle includes tires and steel. Fixed costs. Fixed costs are those costs which do not vary with the number of goods or services a company produces over a short term. For example, suppose a company leases a machine for production for 2 years. The company has to pay $2,000 per month to cover the cost of lease, no matter how many products that the machine is used to make. Variable costs. Variable costs, on the other hand, fluctuate as the level of production output changes, contrary to a fixed cost. This type of cost varies depend on number of product a company produces. A variable cost increases as the production volume increases, and it falls when the production volume decreases. Overheads. Overheads are business costs that are related to day-to-day running of a business. Unlike operating expenses, overheads cannot be traced to a specific cost unit or business activity. Instead, they support the overall revenue generating activity of the business. Types of overheads. It is fixed overheads. Fixed overheads are costs that remain constant every month and do not change changes in business activity. Example of fixed overheads include salary, rent, property tax. So variable overheads. Variable overheads are expenses that vary with business activity levels and that can increase or decrease with different levels of business activity. During high levels of business activity, the expenses will increase, but with reduced business activity, the overheads will substantially decline or even be eliminated. Semi-variable overheads. Semi-variable overheads are which includes both fixed and variable overhead. A business may incur such cost at any time, even though the cost will fluctuate depending on the business activity level. A semi-variable overheads may come with a base rate that the company must pay at any activity level plus variable cost that is determined by the level of usage. Now coming to the difference between financial accounting and cost accounting. So the main purpose of financial accounting is to ascertain profit earned or loss suffered during a particular period of time. The main aim or objective of cost accounting is to provide costing information to management that facilitates for decision making. Stages. Next one, the statutory obligation to firm is to maintain financial accounting, but the firms need not maintain cost accounting. So the uses of financial accounting are the investors, creditors, labor union, and they are all the external uses. The uses of the cost accounting are internal to the organization. So the financial accounting analyzes the business affairs totally. The cost accounting analyzes the business affairs product wise, service element wise, or activity wise. So in financial accounting, it does not have any provision of cost control. It merely operates on financial conditions on annual basis. In cost accounting, it records aim on controlling costs such as material, labor, and overheads. So the reports are prepared in financial accounting for a specific period of time. In cost accounting, it is prepared when and whether when it is required by the management. It is financial accounting. It is the historical in nature and it records the past transactions only. But in cost accounting, it records future as well as the past transactions. Inventory valuation in financial accounting is cost price or market price, whichever is lower. But in cost accounting, the inventory is valued at cost price.